So on that note, it's with great pleasure that I welcome our first presenter, Philippa, who's Managing Director of Cargill Australia. Philippa has been a familiar figure in the agribusiness media sector lately, particularly with her involvement with the recent Global Food Forum up in Sydney. Philippa has been involved with Cargill for over 20 years, both in Australia and worldwide. So like many others, today I'm very keen to hear Philippa's presentation, and I welcome you to the stage, Philippa.
Good morning, everybody, and thank you for the invitation to be here. Okay, so we're talking about investment in agriculture, and as the first speaker, I am basically not going to talk about Australia. So I will talk about much more about the global picture, and then we'll come down, and we've got 3 experts across the Australian side who'll get into much more detail about the local situation here. So what I will do is talk a little bit about why, at a global level, the investment interest is growing, where it's coming from and where it's going to, and some of the outcomes and responses. So first, to try and put a size on the kind of market that we're talking about. It's actually pretty hard to get reliable data on FDI into ag and agribusiness because the numbers really don't exist. Very few countries report, and what is reported isn't terribly reliable. But very roughly, if you think about all foreign investment at a global level across all sectors, then agribusiness in total gets about 5% of that. So pretty small. And when you think about primary agricultural production, it's half of 1%. So small number, but growing. And particularly when you look at the primary ag part, it really didn't exist until about 10 years ago. And particularly since the food spike of 07-08 is when you've started to get a lot more interest into foreign investment into primary ag. And so if you think about that in billions of dollars, it's roughly on an annual basis somewhere between 13 to 25 billion that's going into agriculture. So that's the kind of numbers that we're talking about. Why is it coming in? Well, the one thing that gets the most press is obviously that we need more food to feed the hungry world. So we've got growing population, growing middle class, and changing diets. And you can see all sorts of predictions about how we need to raise food production by 70% by 2050 and these kinds of numbers. And whatever numbers you choose to look at, it is perfectly clear that we do need to produce more food. And it's also clear that although you've seen some origins have significant increases in yields, we're not going at a pace that will meet the demand. And so we do need to have more investment and produce more food. But it's not just about producing more food, because there are 2 other parts to this story. One is about the fact that we waste so much of what we produce. At the origin and in developing countries, we waste what we're growing, and so it either goes rotten or it gets contaminated on the way to being processed. And at the end, and particularly in developed countries, we throw things away. So we throw away bottles of milk. We throw away salad that goes off in the fridge. And so if we could only do a better job about changing and getting our supply chains more efficient, we could actually do a much better job of feeding the world. There is no need for anyone today to be hungry. We produce enough calories to feed the world. We're just not getting them to the right place. And the third element in this that we have to remember is the part about biofuel. Because when we talk about a hungry world, it's not hungry just for food, it's also hungry for energy. And from 10, 12, let's call it the start of this century really, we've had a growing interest and a number of mandates for biofuel. So taking food commodities and turning them into energy. Not sure that that's really the right way to use food ingredients, but the growing concern around energy has meant that that's what we've done. And so it's not just about feeding the world, it's also about the fuel side of it, and it's also about putting money into infrastructure and supply. The graph here shows world food flows, and so food that flows across regional boundaries. What you can really see is, if you look particularly at the Asia number, it's close to tripled in around 20 years. And so what you're seeing, particularly in Asia, is that's where we're seeing a lot of the population growth and a lot of the growing middle class, and that's where we're seeing the changes in demand. And Asia cannot produce all the food that it needs. If you look at China specifically, it's 20% of the world population, and it's got 7% more or less of the world's agricultural land. And so you haven't got self-sufficiency, they need to import. As you get that, we can have a nice debate about foreign investment here in Australia, but in the global context, taking everybody in the world, it isn't a discussion about whether FDI is nice to have. We need it. We absolutely need it. And what we need to be doing is make sure that we get all the benefits out of it and maximize those and mitigate the risks. When you get down to individual countries, particularly in the developed world, you can have different kinds of discussions. But at a global level, if we don't get more investment into ag and agribusiness, we will not be able to feed the world going forward. No surprise in that context, when we've got a growing demand, that the price of land is going up. And so this is something that investors particularly look at. So this is over the last 10 years. And no surprise also that you see that the developing regions are the ones that have seen some of the greatest increases. So places like Brazil and Eastern Europe. And that capital growth story is something that will probably continue and is a large part of the investment story. This kind of investment is different to other types of investment because a lot of FDI that comes in other sectors is around access to markets or access to labor. This is access to natural resources. This is about land and water. So it is slightly different. Okay, so where's the money coming from? So some of the obvious ones are ag and food companies like Cargill, who I work for. And they will see commercial opportunities. Cargill is a private company, continues to reinvest the majority of its earnings back into the business and has grown at a substantial rate through the 150 years that we've been around. Beyond the ag and food companies, you also increasingly see energy companies getting into investment. And so what we've seen, since you've had biofuel, if you've seen ag commodities and mineral commodities come together to create one commodity asset class. And that simply didn't exist before. And so 20 years ago, the price of corn and the price of wheat had absolutely nothing to do with the price of petroleum. Just no link. But by the time that you start turning corn into ethanol, and you turn soybean oil into biodiesel, and you're turning sugar into ethanol, you're bringing energy and ag together in a way that didn't exist before. And so just as ag companies are now becoming more interested in energy, you're also seeing energy companies get interested in ag. And so companies even like Vitol are starting to see now here in Australia. So you're getting ag and food companies investing FDI, you're getting the energy companies, and then as we talked about food security, you start to see countries say, okay, we're not going to be able to grow enough affordable, nutritious food for our own people, and so we're going to have to import. And China, I think, is quite significant that this in the last 12 months has acknowledged that that goal of self-sufficiency that they've had for so long is not viable. And so they've accepted that they're not going to be able to feed their own people with domestic production. And that's true, obviously, of the Middle East as well, which again doesn't have the agricultural land to feed their population. And so where are they going to get this food from? And so they can buy it commercially in the market, but I wouldn't, one of the things that happened through this food spike in 2007 and 2008 is that really scared a lot of governments. Because as you got that price spike, a lot of countries then put export bans on. And so they weren't sure when the supplies were coming from and if they were going to be reliable. And they weren't sure about the prices because the prices went strongly up and then came down. So a lot of volatility in the prices as well as unreliability of supply. And so a lot of countries at that point said, well, we need to do more to manage our self-sufficiency. And that's the time that you started to see a lot more foreign investment coming in as people tried to secure those chains. Some of it through commercial enterprises and some of it through sovereign wealth funds. And so you're seeing sovereign wealth funds get into things like corporate farming, which really has only been around for about the last 10 years. And you're also starting to see equity investments. And so, for example, Temasek, which is a Singapore sovereign wealth fund, investing in Olam. or COFCO, which is a Chinese state-owned enterprise, investing in Noble and Nidera. The other thing that you're starting to see in foreign investment is hedge funds. And so this, again, only in the last 10 years, and particularly as you've started to see commodities act as an asset class. And they get interested about food, one, because they see this food story and they say, we've got to feed this hungry world. But they also like commodities because it's a hedge against inflation. As a result of all the quantitative easing that we've seen since the global financial crisis, there's an expectation that at some point we will start to see inflation coming back. At that point, being long commodities is a good answer to that risk around inflation, because the commodities will normally go up as inflation goes up. It's also a diversification play, because at a time when you've got lower interest rates and equities and bonds returns have been variable, being in commodities is a way of diversifying their portfolio. And so a lot more interest in ag and agribusiness, and a lot more foreign investment coming from a lot of different sources. Where did the money go? Well, 70% of FDI in primary ag has gone to just 11 countries. And it's particularly noticeable when you look at that map that 7 out of 11 are in Africa. And you cannot understate the importance of Africa when we think about feeding the world. If we are going to do that by 2030, 50, whatever date you want to choose, Africa has to be a piece of the answer. And that may sound like a slightly strange thing to say, because Africa really hasn't been part of the solution or the answer so far. And that's because we've seen problems around land rights, water management, political instability, financing. But when you look at available land that today isn't being used for agriculture but could be, a lot of it is in Africa. Places like Sudan, Zimbabwe, Zambia. So we do need to sort some of those issues to be able to make them productive, but you're starting to see the investment there. And it really does need to come from foreign investment, because locals and local governments don't have the money. So it is an undeniable fact, and it's a great fact, that most of investment in agriculture is going to come from local farmers. That's true today, true in the past, going to be true in the future. But particularly when we think about developing countries in the global context, we need that foreign money, and Africa's a good example of that. So large parts of Africa, the money there has come from the Middle East, it's come from China, parts of Southeast Asia. When you look at Latin America, it's mainly Brazil and Argentina, and a lot of that money has come from North America and from Europe. And the statistics on how it's being used is more or less around 83% in broadacre, 13% livestock, and 4% in more permanent crops like viticulture or sugar. So vast majority, significant majority going into broadacre farming. All right, when it works well. So when foreign investment in agriculture works well, for a start, you get investment into not only into the agricultural side of it, but into infrastructure. And so, for example, when you look at Brazil, which is a huge country, a very undeveloped road system, unless you can not only grow the crops, but also get them to market, it doesn't work, because the price that the farmer gets is too low, and or you just lose too much in the transport. This is also true of large parts of Eastern Europe. And so we've been able to bring large parts of production in Eastern Europe, places like Ukraine and Russia, because there's been investments into ports, into roads, into rail. That's where foreign investment can bring some of that money. Also through technology. It's incredible how we've been able to change yields in farming through the Green Revolution. And that can be around crop inputs, seed varieties, precision farming, all sorts of things come into that. But getting some of that technology to places that don't have it today is part of the answer that foreign investment can bring. Also around food safety. And so, for example, Cargill has built a business in chicken production in China. And one of the reasons that we have customers who want to buy chickens from us is because we bring the knowledge around food safety that some of the local producers don't have. And after the number of food scares that there's been in China recently, obviously there is a growing concern and desire to have much safer food and make sure that it is okay to eat. When it works, it should also bring employment, efficiency, and net of all of that, you help reduce poverty. There isn't one model that works everywhere, but essentially when foreign investment works well, you must have the local communities working well with the foreign investors. And when things go wrong is when you haven't got those two aligned. And so this is where the issue around governance comes in. And different types of governance in different places, but what we must see is things around labour. And so you absolutely need to make sure that you're paying people a fair wage. You need to make sure there's a framework for tax to avoid corruption. You need to make sure that farming, when it comes to foreign investment, is sustainable. And so a lot of focus on palm, for example, in Indonesia and Malaysia. Cargill's been involved in that and has been very, very involved in the responsible palm production. Also in Brazil, where there's been a lot of issues obviously around destruction of the rainforest. We've been part of working around soybean production and making sure that that comes from land that is not deforested, and we will not buy soybeans from areas that have been deforested. And so when you've got communities working well together, it can work, and when it doesn't, it's things that go wrong. One of the metrics that we have as a company, and we have 4 metrics in fact, but one of them is enriched communities. And we take as a company extremely seriously the concept that we must bring something to the communities where we live and work. And that can be in places like Vietnam, where we build schools for kindergarten and make sure that they can get to learn to read and write, teaching farmers about safe, sustainable practices for cocoa in West Africa, or even here in Australia, where we have a lot of storage sites, and the spare land around those storage sites we use for cropping, and then use the revenue from that to go back into local communities, and it's the local communities who decide where that money goes. But I take it as something very important, so does the company I work for, and I think this is when foreign investment has to work well, is when you're thinking about that. If you're not thinking about the communities and how you're working together with the foreign investment, that's when you do get problems. Now, when you do get problems is when you start to get restrictions. And so here's some overview of how it looks for restrictions of foreign investment in land. And this is a changing picture, obviously. Not many countries have a truly free market. And UK and Ireland are up there. But in fact, even in those 2 countries, that there is a preference towards investment from other European countries, and there are some level of small restrictions on investment that comes from outside the EU. So within EU countries, there are specific restrictions between each other. You then have a number of countries that have a relatively free market, but with some regional restrictions. So for example, in the US, in large parts of the Midwest, you're not allowed to sell land to foreign investors, but you can lease it. And this is one of the things, when you look at the numbers on foreign investment, one of the reasons it's so hard to get numbers is because it's really hard to work out actually what kind of transactions have gone on. When you really sell land, then you can see where that's happened. And roughly, when I was talking about Africa, it looks like in the last 10 years there's been about 56 million hectares of land that's been sold or long-term lease of up to 100 years in Africa. Still a very small percentage of the overall available land in Africa, but sizable amount, and probably a fair amount of that is some of the better land. But some of it can be sold, some of it can be leased, and it can be leased long-term, or it might just be leased for 1 or 2 years. And so what you see in the Midwest of America, for example, is a lot of lease, but it can be pretty short-term for 2 or 3 years. Now, how do you count that in some of your FDI calculations is one of the issues. Another model that you can also come up with is things like, for example, the European supermarkets contract grow fruit and vegetables. It's not foreign investment, but it is contract growing. It's one of the ways that you can at least get a defined and clear market for some of the producers. The longest list, and I've only chosen some of the countries here obviously, but the longest list is countries that have partial restrictions. And so it either requires approval or some types of buyers aren't allowed to buy. Australia comes in that list, and you'll hear a lot more from the other speakers about exactly how that works here. And you start to see other parts of Eastern Europe through here, some parts of Africa, and Argentina and Brazil. And so even though Argentina and Brazil were on the list of countries that have had large amounts of investment, they've actually tightened the rules recently. And so particularly in Argentina, there was a lot of land that was sold. There's now a much more left-leaning government, and they've put a lot more restrictions on it. And Brazil has also started to tighten those up. So they were a lot more open and have become more restricted. And then you get a couple of countries that essentially allow no foreign ownership. China comes in there. Ukraine, you're also not allowed to own. And then countries like Belarus, there is actually technically no private ownership at all, not only for foreigners, but also for locals. So very different models, very different ways of getting there. And it does depend, obviously, on whether you're a country that has an excess of food, and so you have an exportable surplus, or you're a country that is deficit and needs to import. And so when you're getting restrictions, often it's more from countries who have the ability to grow, but are concerned that that production then might go overseas and they won't have enough for the domestic market. Australia is lucky enough to be able to grow pretty much everything that we want to eat here, and still have an exportable surplus that we can sell, particularly in wheat and beef and other products. Even so, the issue of foreign investment is a highly emotive one, but it becomes obviously a lot more emotive if you're actually deficit and you start to see different supply chains. Okay, I'm going to leave it there, and then we'll get more into Australia afterwards, but I'll take any questions on the global stage if anyone has any at this point. Yes?
John Gunthorpe, from Australian Beef Industry Foundation. I know that Excel, when they had an investment in Brazil, withdrew in the 80s and 90s because of corruption and concerns about corruption in the Brazilian beef industry. I just wondered, to what extent do you think corruption is an inhibitor to foreign investment in countries such as Third World, like Africa and South America?
So we take ethics extremely seriously. We will abide by all laws of the country, and we will also go higher than that because we need to make sure that we're doing the right thing. That means in some cases it is hard to make investments. In most cases what we've found is that it is possible to make investments, but it can be slower. And so, for example, we have a large number of investments in Russia and Indonesia, in India, in Brazil, countries that have had a history of difficulty with corruption. Sometimes we're just slower to get there. Sometimes we've had to choose to get out of businesses because we don't think that we can run in the way that we want to. It was interesting that Walmart's been struggling recently and is facing fines for corruption. And essentially what they were doing was paying to get licenses to be able to move forward. And so a lot of it's about getting things done quicker. So I think it just means sometimes if you want to do the right thing, it's slower. I think the bar is rising, and I think that's fantastic, that the freedom to operate is actually lower. And that's good in the sense that I think there is a growing belief that companies who come into a country must do the right thing, and people want to monitor to that and see if they're doing it. And so the more that we get a level playing field on that, personally as Cargill, I'm delighted because we're going to follow that rule anyway, and I hope everyone else will. So it can inhibit, but I think there's a growing monitoring of that. And our CEO actually said, in a world where there are no secrets, you better not have any. And I think that's right. I mean, there are no secrets now, and so if you're going to do the wrong thing, it will come out. And so bring on the rules and regulations on that side, I say. Hi.
Hey, you mentioned that there's 4 metrics that Cargill have.
Yep.
And you mentioned the community as well. I was interested in what the other ones were.
So the first one is engaged employees. And that includes safety, development of employees, and it's first because if you don't have engaged employees, you don't get to the second one, which is satisfied customers. So it goes engaged employees, satisfied customers, enriched communities, profitable growth. And we put them in that order very specifically because you won't get to the last one, which is where a lot of people would tend to focus on if you don't have the first three. But those are the four.
Thank you, Brian. I noticed Ukraine's fully restricted on foreign investment, yet apparently has the potential of producing huge quantities of grain.
Yes.
Have you attempted to get in there, or is there any move to try and penetrate Ukraine?
So Cargill generally, and I'm going to have to qualify this, but generally is not involved in primary ag production, so we don't call ourselves farmers. There are a couple of exceptions. One is around palm, and so we do have palm plantations in parts of Southeast Asia. We also have very limited investment in sugar in Brazil, and we have ownership of a hedge fund called Black River, which is involved in some corporate farming. But in general, we're not involved in agricultural production. We do have large asset footprint actually in Ukraine, and that's really around processing. And so we have oilseed processing, grain origination and distribution. It is there was a fantastic rumor that went out a few months ago that a Chinese fund had bought up half the land in Ukraine. It was a clear rumor because you're just not allowed to. I think what you are going to see in Ukraine is a lot of companies starting to bring agronomic services and products, and so it has got huge potential. I think you will start to see some change, but I mean honestly, Ukraine is a particularly hot topic at the moment, right? We don't even know who's running Ukraine at the moment, and so in the context of where it's not even clear who the government is and what's going on, that obviously is particularly difficult at the moment. But they have welcomed investment in processing and downstream activities, and also in things like crop inputs. What they haven't welcomed so far is the primary ag, but that may or may not change. Honestly, don't know where that country's going today.
We have time for one more question. If anyone's interested in...
Michael Gowing, member of the council here. China exports food to us. Why would they do that when there's a deficit in their own food production in terms of their own internal demands?
Well, so this is it's an interesting question. So the concept of flows going both ways. China's a big country for a start. And so one of the things about China is it's sometimes easier to get things out of China into other countries than it is to get them through China up into other parts of the country, and you can do that more cheaply from other origins. So part of it's just to do with internal distribution and transportation, and part of it's about the type of food. And so in some cases, countries can be extremely good at producing one thing and not at something else. One of the interesting examples to me on this actually is Cuba. And so Cuba is a fantastic place to grow sugar. They used to be one of the leading producers of sugar, and the entire sugar market would largely depend on what Cuba was doing. Today, they're completely out of the market. It's Brazil, and nothing else. And one of the things that Cuba did was they said, okay, we want to produce, we're making all the sugar, but way more than we need, so we'll export all the sugar and we'll import all the things that we need. But they had obviously considerable restrictions because of the sanctions on what they could import. So they said, okay, we'll start producing dairy, and we'll produce meat, and we'll produce all the things that we're importing today. So they took all the land that was producing sugar, and they tried to make it produce something that it wasn't fit to produce, and they getting terrible yields on dairy and terrible results on everything else, and they haven't got any of the revenue from sugar. And so one of the things that you need to be able to do, I believe, is give up the idea of self-sufficiency, because doesn't work in the market. Grow what you're really good at, sell it to the markets that you can be competitive to, and then import what you're not good at producing. And even within a country as big as China, sometimes that can mean within regions exporting and importing in another part.
Thank you, Philippa. As I said before, there'll be more time to ask questions for Philippa later on.